Now let's continue with chapter 2. Anyway, I'll give the problems. We will take up the problems siguro Monday na, no? So for the different chapters that we can discuss the theory part by now. So for the statement of financial position in chapter 2, that's one of the basic statements. So we have now for the statement of financial position. Now we have the following objectives to define the statement of financial position, to understand the current and non-current classifications of assets and liabilities, to understand refinancing of a currently maturing debt, to identify the components of equity in a corporation, to identify the minimum line items in a statement of financial position, and to be able to prepare a statement of financial position using Philippine format and IFRS format. Now, with these objectives in mind, we have to achieve after discussing the chapter. So for the statement of financial position, being a formal statement showing the three elements comprising financial position: assets, liabilities, and equity. So which would either be owner's equity or stockholders' equity. Investors, creditors, and other statement users analyze the statement of financial position to evaluate such factors as liquidity, solvency, and the need of the entity for additional financing. So we have the two most important factors, liquidity and solvency. Liquidity being the ability of the entity to meet currently maturing obligations, and solvency is the availability of cash over the longer term to meet maturing obligations. Now, we have the information about liquidity and solvency is useful in predicting the ability of the entity to comply with future financial commitments and to pay dividends to shareholders. So you would refer to when we talk about liquidity, we are now referring to the assets, especially cash, which is available for immediate use. So in other words, it's not intended for a specific purpose. So we have now for cash, which is considered to be non-restricted, no? So in that case, we will involve this terms again when we go to problems that we will be solving. Now, for current and non-current distinction, we have the entity shall present current and non-current assets and current and non-current liabilities as separate classifications in the statement of financial position. So when an entity supplies goods or services within a clearly identifiable operation cycle, the separate classification of current and non-current assets and liabilities is useful information, highlighting assets that are expected to be realized within the current operating cycle and liabilities that are due for settlement within the same period. Now, the current operating cycle, which is normally 1 year, but it depends upon the company involved with whatever is its current operating cycle. So when we talk about 1 year, it may be a fiscal year or a calendar year. So we have to consider the type of counting period used. So for some entities, as financial institutions, a presentation of assets and liabilities in increasing or decreasing liquidity provides information that is faithfully represented and more relevant. So we have now the current assets classification. An entity shall classify an asset as current when A, the asset is cash or a cash equivalent unless the asset is restricted to settle a liability for more than 12 months after the reporting period. So for example, you have sinking fund cash. Now that is intended to pay a long-term liability like bonds. So the sinking fund cash cannot be considered as unrestricted or available for immediate use for other purposes because it's intended only to pay a long-term liability. That's why we call it sinking fund, to pay a long-term liability. So it cannot be a current asset. The entity holds the asset primarily for the purpose of trading like merchandising, buying and selling of goods. The entity expects to realize the asset within 12 months after the reporting period and expects to realize the asset intends to sell or consume it within the entity's normal operating cycle. Now, how do we present current assets? Now, usually listed in the statement of financial position in the order of liquidity. So liquidity would mean which of the assets are easily convertible to cash. So we have now your paragraph 54, providing that as a minimum, the line items under current assets are cash and cash equivalents. We have financial assets at fair value through profit and loss, such as trading securities and others, quoted equity, and other quoted equity instruments, trade and other receivables, inventories, and prepaid expenses. So we are now talking about trade, like your accounts receivable and notes receivable related to the sale of merchandise on account. Now we have now the non-current classification states that an entity shall classify all other assets not classified as current as non-current. In other words, what is not included in the definition of current assets is deemed excluded. All other assets or all others are classified as non-current assets. Accordingly, non-current assets include property, plant, and equipment, long-term investments, intangible assets, and other non-current assets. So we have now paragraph 56 now provides that deferred tax asset is a non-current asset. So again, take note that we have four classifications of the non-current assets: property, plant, and equipment, long-term investments, intangible assets, and other non-current assets. Now we go to current liabilities. Now, current liabilities provides that an entity shall classify a liability as current when it expects to settle the liability within the entity's normal operating cycle, holds the liability primarily for the purpose of trading. So you talk about accounts payable and notes payable related to the purchase of merchandise or raw materials on account. The liability is due to be settled within 12 months after the reporting period, and the entity does not have an unconditional right to defer settlement of the liability for at least 12 months after the reporting period. So I'll repeat, the entity does not have an unconditional right to defer settlement of the liability for at least 12 months after the reporting period. Now, how do we present the current liabilities? We have now the following order of presentation: trade and other payables, so that includes accounts and notes, trade payables, current provisions. So we have now your currently due provisions. Then we have short-term borrowings, current portion of a long-term debt, and current tax liability. The term trade and other payables line item for accounts payable, notes payable. Again, I would like to specify trade notes, because you may have notes that are not related to trade transactions, should be separated. Accrued interest on notes payable, dividends payable, and accrued expenses. So you may include accrued light, accrued utilities. Now, no objection can be raised in the trade if the trade accounts and notes payable are separately presented. Now, the non-current liabilities is a residual definition. PS1 simply states that all liabilities not classified as current liabilities are non-current. So we have non-current portion of a long-term debt. Supposing you have a long-term debt payable in 5 years, so the 1 year portion is current, while the 4 years portion is non-current. Please, liability, deferred tax liability. So in connection with deferred tax asset being non-current, deferred tax liability is non-current as well. Long-term obligations to entity officers, like advances from officers, then long-term deferred revenues. So you have, if your rental income was collected good for 5 years, so the 4-year portion is deferred revenue, that's non-current. And paragraph 56 provides that deferred tax liability is a non-current liability. Now we have contingent liability defined in 2 ways. It's a possible obligation that arises from past event and whose existence will be confirmed only by the occurrence of non-occurrence of one or more uncertain future events not wholly within the control of the entity. A contingent liability is a present obligation that arises from past events but is not recognized because it is not probable that an outflow of resources embodying economic benefits will be required to settle the obligation, and the amount of the obligation cannot be measured reliably. Now, these are the two conditions considered to be contingent liability, and it's not an accrued liability yet it's still considered to be contingent. So again, I'll repeat, it's not probable that an outflow of resources embodying economic benefits will be required to settle the obligation, and the amount of the obligation cannot be measured reliably. Thus, a contingent liability is either probable or measurable, but not both. So either of these two. Then we have now contingent assets as a possible asset that arises from past event and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future event, not wholly within the control of the entity. Contingent assets usually arise from unplanned or other unexpected events that give rise to the possibility of an inflow of economic benefits to the entity. An example is a claim that an entity is pursuing through legal process when the outcome is uncertain. So the possibility that a company may have a claim if it wins the case. However, it may also involve a contingent liability if the case is otherwise. Then we have now equity. The term is the residual interest in the assets of the entity after deducting all liabilities. Equity means net assets or total assets minus liabilities. Now, you have taken this in your basic accounting subjects, no? The meaning of equity is increased by profitable operations and contributions by owners. However, it's decreased. It will be decreased by unprofitable operations and distribution to owners, or the giving of dividends for corporate businesses, or the withdrawals of the owners or the partners for single proprietorship and partnership. The terms used in reporting the equity of an entity, depending on the form of the entity, are owner's equity in a proprietorship. Then we have partner's equity in a partnership and shareholders' equity in a corporation. So that would be shareholders' equity. So, however, the term equity may simply be used for all business entities. So that's the general term. Shareholders' equity or stockholders' equity is the residual interest of the owners in the net assets of a corporation measured by the excess of assets over liabilities. Generally, the elements constituting shareholders' equity with their equivalent IAS term are. So we have now Philippine term, and we have the IAS term capital stock. So we have now share capital, subscribe capital stock, subscribe share capital, and then the common stock, ordinary share capital, preferred stock, preference share capital, additional paid-in capital or share capital, retained earnings, deficit, accumulated profits or losses. Then we have retained earnings appropriated. Then we have your appropriation reserve, revaluation surplus or revaluation reserve, and we have treasury stock or treasury share. Now, the IAS that we used to call before, the IAS or the International Accounting Standard, is presently known as International Financial reporting standard. So you take note of that. The IAS term is actually considered or called by now as the IFRS. The IFRS, or International Financial Reporting Standard. Take note of that IAS term or IFRS. Now we have the line items in the statement of financial position. The statement shall include the following line items. 1. Cash and cash equivalents, financial assets, other 1, 3, and 6. So other than 1, 3, and 6. So we have now your trade and other receivables, inventories, property, plant, and equipment, investment in associates using the equity method. Then we have the intangible assets. We have intangible assets in number 7. Number 8, investment property, biological assets, and we have the total assets here classified as held for sale, and assets included in disposal group classified as held for sale. Then we have trade and other payables. For the liabilities, current tax asset and liability, deferred tax asset and deferred tax liability, provisions, financial liabilities other than 11 and 14. Then we have liabilities included in disposal group, held for sale, non-controlling interest, share capital, and reserve. So we have now those line items to be remembered. Then we have the forms of statement of financial position. Now with the format is not specified. In practice, there are two customary forms in presenting the statement of financial position, namely the report form, where it sets forth the three major sections in a downward sequence of assets, liabilities, and equity, or the account form. As the title suggests, the presentation follows that of an account, meaning the assets are shown on the left side and the liabilities and equity on the right side of the statement of financial position. So it follows the sequence in a T account. Now that's the account form. Okay? Then, so we have the statement of financial position. Now we are going to take up the problems together with the other chapters. For the meantime, we go now to chapter 3. No, I'm trying to finish the theories. I have told you that I am going to discuss up to chapter 9 so that your reporting will begin with chapter 10. However, by now, I just tackle the theory part and later on take up the problem. So chapter 3 is actually notes to financial statement. Chapter 3, notes to financial statements. Okay, so to follow, we have chapter 3, notes to financial statements. And here we have the related parties and events. Related parties and events after the reporting period are included in chapter 3. So for the notes to financial statements. Now, we have the following objectives in the study of the chapter: to understand the nature and purpose of notes to financial statements, to identify related parties, to identify or determine the requirements for disclosure of related party transactions, to understand the concept of events after the reporting period, and to identify the types of events after the reporting period. Now we have notes, provide narrative description or disaggregation of items presented in the financial statements and information about items that do not qualify for recognition. Now, notes contain information in addition to those presented in the statement of financial position, income statement, statement of comprehensive income, changes in equity, and statement of cash flows. In other words, notes to financial statements are used to report information that does not fit into the body of the statements in order to enhance the understandability of the statements. Notes provide additional information and help clarify the items presented in the financial statements, and provides that an entity shall, as far as practicable, present notes in a systematic manner. Now, the purpose of notes to financial statements is to provide the necessary disclosures required by the Philippine Financial Reporting Standards, or the PFRS. And we have provides that the notes to financial statement shall present information about the basis of preparation of the financial statements and the specific accounting policies. So as provided now by the Philippine Financial Reporting Standards, disclose the information required that is not presented in the financial statements, provide additional information which is not presented in the financial statements but is relevant to an understanding of the financial statements. Now, what will be the order of presenting notes? So we have here the entity normally presents notes in the following order to assist users understand the financial statements and to compare them with financial statements of other entities. So first, we have the statement of compliance with PFRS, summary of significant accounting policies used, supporting information or computation for line items presented in the financial statements and other disclosures such as contingent liabilities, unrecognized contractual commitments, and non-financial disclosures. Next, we have the related parties. As you can remember, we have one of the objectives there related to related parties and disclosure requirements, and as well as the unrelated parties. Parties that are considered to be related, if we have now one party has the ability to control the other party, the ability to exercise significant influence over the other party, and joint control over the entity. And we define control as the power over the investee or the power to govern the financial and operating policies of an entity so as to obtain benefits. And it is the ownership directly or indirectly through subsidiaries of more than half of the voting power of the entity. So if we are now talking about parent and subsidiary relationships. Significant influence is the power to participate in the financial and operating policy decision of an entity but not control of those policies. Significant influence may be gained by share ownership of 20% or more of the investee company. So we have now the following as examples of related parties, entities that directly or indirectly through one or more intermediaries control or are controlled by or under common control with the reporting entity pertaining squarely to affiliates, meaning the parent, the subsidiary, and fellow subsidiaries. 2. Associates, there are entities over which one party exercises significant influence, and this includes the subsidiary or subsidiaries of the associate. 3. Venturer in a joint venture. A joint venture includes the subsidiary or subsidiaries of the joint venture. And 4, we have the key management personnel are those persons having authority and responsibility for planning, directing, and controlling the activities of the entity directly or indirectly, including any executive director or non-executive director. Now, we are still talking about the examples of related parties. Close family members of an individual are those family members who may be expected to influence or be influenced by that individual in their dealings with the entity. And close family members of an individual include the individual spouse and children, children of the individual spouse, dependents of the individual or the individual spouse. 6. Individuals owning directly or indirectly an interest in the voting power of the reporting entity that gives them significant influence over the entity and close family members of such individuals. And 7, post-employment benefit plans for the benefit of employees of an entity or of any entity that is related party to that entity. Now we have examples of related party transactions being a transfer of resources or obligations between related parties, regardless of whether a price is charged. So we have now the following examples of related party transactions: purchase and sale of goods, as sale of property and other assets, rendering or receiving services, leases, transfer of research and development, license agreement, finance arrangements, including loans and equity contributions in cash or in kind, guarantee and collateral and settlement, if liabilities on behalf of the entity or by the entity on behalf of another party. Now, with related party disclosures, requiring disclosure of related party relationships where control exists, irrespective of whether there have been transactions between the related parties. In other words, relationships between parents and subsidiaries shall be disclosed regardless whether there have been transactions between those related parties. An entity shall disclose the name of the entity's parent and, if different, the ultimate controlling party. If neither the entity's parents nor the ultimate controlling party produces financial statements available for public use, the name of the next most senior parent that does so shall also be disclosed. So we have now disclosures of related party transactions. Provides that if there have been transactions between related parties, an entity shall disclose the nature of the related party relationship as well as information about the transactions and outstanding balances necessary for an understanding of the financial statements. As a minimum, the disclosures of related party transaction shall include the amount of the transaction, the amount of the outstanding balance, terms and conditions, whether secured or unsecured, and nature of consideration to be provided in settlement. The allowance for doubtful accounts related to the outstanding balance, the expense recognized during the period in respect of doubtful accounts due from related parties. Disclosures that related party transactions were made on terms equivalent to those that prevail in arm's length transactions are made only if such terms can be substantiated. Now, for the key management personnel compensation, provides that an entity shall disclose key management personnel compensation in total and for each of the following categories: A, short-term employment benefits; B, post-employment benefits, for example, retirement pension; C, other long-term benefits; D, termination benefits; and E, share-based payment transaction, for example, share options. Next, for the unrelated parties, including the following: two entities simply because they have a director or key management personnel in common. Now remember, unrelated parties. Providers of finance, trade unions, public utilities, and government agencies in the course of their normal dealings with an entity by virtue only of those dealings. As single customer, supplier, franchisor, or general agent with whom an entity transacts a significant volume of business merely by virtue of the resulting economic dependence, and two venturers simply because they share joint control over a joint venture. Now, related party disclosures, in this case, not required. Here, requiring disclosure of related party transactions and outstanding balances in the separate financial statements of a parent, subsidiary, associate, or venturer. That's in accordance with paragraph 3 of PES 24. However, paragraph 4 provides that intra-group related party transactions and outstanding balances are eliminated in the preparation of consolidated financial statements of the group, pricing policies, accounting recognition of a transfer of resources is normally based on the price agreed upon between the parties, between unrelated parties. The price is an arm's length price. Between related parties, there may be a degree of flexibility in the price setting process that is not present between unrelated parties. So, however, we can say that your related party transactions, PS 24, did not provide for a measurement or related party transactions, however, for that purpose. Now, we have the case of PES 24 did not provide for a measurement or related party transaction for that purpose. And we now have however, here, a variety of methods issues to price transactions between related parties. I'll repeat for that purpose, no? We are going to consider the last part there with an a statement. However, a variety of methods is used to price transactions between related parties. Now we have here the uncontrolled price method, setting the price by reference to comparable goods sold in an economically comparable market to a buyer and related to the seller. The sale price method is often used where goods are transferred between related parties before a sale to an independent party is made. This reduces the retail price by a margin representing an amount from which the reseller would seek to recover costs and make an appropriate profit. We have the cost plus method, seeking to add an appropriate markup to the supplier's cost, and the no price method, literally no price is charged, as in the case of free provision of management services and the extension of free credit on a debt. Now we have events after the reporting period. Defining events after the reporting period as those, whether favorable or unfavorable, that occur between the end of reporting period and the date on which the financial statements are authorized for issue. Events after the reporting period are also known as subsequent events and may require either adjustment or disclosure. Types of events after the reporting period. One, we have the adjusting events after the reporting period are those that provide evidence or of conditions that exist at the end of reporting period. And non-adjusting events after reporting period are those that are indicative of conditions that arise after the end of reporting period. Now, we have examples of the adjusting events here after the reporting period, which require the entity to adjust its financial statements. One, settlement after the reporting period of a court case, because it confirms that the entity already had a present obligation at the end of the reporting period. Bankruptcy of a customer, which occurs after the reporting period. Sale of inventories after the reporting period may give evidence about the net realizable value at reporting date. The determination after the reporting period of the cost of assets purchased or the proceeds from assets sold before the end of the reporting period. The determination after the reporting period of the profit sharing or bonus payment if the entity has the present obligation at the end of reporting period to make such payment. The discovery of fraud or errors that show the financial statements were incorrect. Now we have the examples of the non-adjusting events, a business combination after the reporting period, plan to discontinue an operation major purchase and disposal of asset or expropriation of major asset by government, destruction of a major production plant by a fire after the reporting period, major ordinary share transaction and potential ordinary share transaction after the reporting period, announcing or commencing the implementation of a major restructuring, abnormally large changes after the reporting period in asset prices or foreign exchange rates, entering into significant commitments or contingent liabilities, for example, by issuing guarantees, commencing major litigation arising solely from events that occurred after the reporting period, change in tax rate enacted or announced after the end of reporting period that has a significant effect on current and deferred tax asset and liability. Now we have the financial statements authorized for issue when the board of directors reviews the financial statements and authorizes them to be issued. And an entity is required to submit its financial statements to the shareholders for approval after the financial statements have been issued. In such cases, the financial statements are authorized for issue on the date of issue by the board of directors and not on the date when shareholders approve the financial statements. Now let's repeat the last statement. The financial statements are authorized for issue on the date of issue by the board of directors, and not on the date when shareholders approve the financial statements. So on the date of issue by the board of directors. Disclosure of date of authorization. We have now paragraph 17 of PAS 10, providing that an entity shall disclose the date when the financial statements are authorized for issue and who gave the authorization. If the entity's owners or others have the power to amend the financial statements after issue, the entity shall disclose such fact. It's important for users to know when the financial statements are authorized for issue because the financial statements do not reflect events after this date. Okay? Now, after this, we go to statement of comprehensive income. Statement of comprehensive income that's already contained in chapter 4, statement of comprehensive income, including its definition, components of other comprehensive income, separate income statement, forms of income statement, and single statement of comprehensive income. That's found in chapter 4 of the latest edition of the book of Valix and Peralta. So we have now the statement of comprehensive income in chapter 4. Before we take up the contents of the chapter, now let's focus on the objectives. Here, we have to understand the nature and usefulness of the income statement, the concept of comprehensive income, profit or loss, and other comprehensive income, to identify the components of other comprehensive income, to recognize the reclassification of the adjustments related to other comprehensive income, and to be able to present the income statement following the functional and natural presentation. Now, with these objectives, let's now define first, comprehensive income. The change in equity during a period resulting from transactions and other events other than changes resulting from transaction with owners in their capacity as owners. Accordingly, comprehensive income includes profit or loss and other comprehensive income. Other comprehensive income comprises items of income and expenses, including reclassification adjustments that are recognized in profit or loss as required or permitted by the Philippine Financial Reporting Standards. Now, we have the following components of other comprehensive income: unrealized gain or loss on equity investment measured by at fair value through other comprehensive income, unrealized gain or loss on debt investment measured at fair value through other comprehensive income, gain or loss from translating the financial statements of a foreign operation, revaluation surplus during the year, unrealized gain or loss from derivative contracts designated as cash flow hedge, remeasurements of defined benefit plan, change in fair value attributable to credit risk of a financial liability designated at fair value, profit, or loss. So we have now your comprehensive income inclusion. So what are included? A presentation of other comprehensive income as provided that the other comprehensive income section shall present line items for amounts of other comprehensive income in the period classified by nature. The line items for amounts of other comprehensive income shall be grouped as other comprehensive income that will be reclassified subsequently to profit or loss when specific conditions are met, and the second one will be reclassified subsequently to profit or loss, but here will not be reclassified subsequently to profit or loss, unlike number one, but this time it will be reclassified subsequently to retained earnings. OCI that will be reclassified subsequently to profit or loss includes gains or losses from translating financial statements of a foreign operation, unrealized gain or loss on derivative contracts designated as a cash flow hedge, and unrealized gain or loss on debt investment measured at fair value through other comprehensive income. Reclassification adjustments are amounts reclassified to profit or loss in the current period that were recognized in other comprehensive income in the current or previous periods. Then we have now the OCI that will be reclassified to retained earnings. Now remember, it's either unrealized gain or loss on equity investment measured at fair value through other comprehensive income. Under PFRS 9, the unrealized gain or loss is reclassified to retained earnings upon disposal of the investment. B, change in revaluation surplus. The realization of the revaluation surplus is through retained earnings. C, remeasurement of a defined benefit plan are not recycled subsequently to profit and loss, but may be transferred within equity or retained earnings. D, gain or loss attributable to credit risk of a financial liability designated at fair value through profit or loss. The gain or loss may be recycled subsequently within equity or retained earnings. Now we have the presentation of other comprehensive income. Here, we have paragraph 81 of PS1 provides that an entity has two options of presenting comprehensive income, namely two-statement approach, an income statement showing the components of profit or loss, and a statement of comprehensive income beginning with profit or loss as shown in the income statement, plus or minus the components of other comprehensive income. And the two single statement approach, combining the statements, the components of profit or loss, and the components of other comprehensive income. For this purpose, we have only one statement to prepare. Now we have the sources of income. We have the sources including sales of merchandise to customers. The income shall include sales to customers during the period minus sales returns, allowances, and discounts. Rendering of services. So we have now the income from rendering of services, among others, including professional fees, media advertising commissions, insurance agency commissions, admission fees for artist performance, and tuition fees. Use of entity resources. This income includes interest, rent, royalty, and dividend income. Disposal of resources other than products. Examples include gain on sale of investments, gain on sale of property, plant, and equipment, and gain on sale of intangible assets. So pertaining to disposal of resources other than products. Now we have the components of expense, cost of goods sold, distribution cost or selling expenses, administrative. Sometimes we call this general or administrative, other expenses, and income tax expense. Now we have the classification of expenses, distribution cost or selling expenses constitute costs which are directly related to selling, advertising, and delivery of goods to customers. Distribution costs include salesmen's salaries, sales commissions, traveling and marketing expenses, advertising and publicity expenses, freight out, depreciation of delivery equipment, and store equipment. Administrative expenses constitute cost of administering the business. These ordinarily include all operating expenses not related to selling and cost of goods sold. Administrative expenses include doubtful accounts, office salaries, and expenses of general executives, office supplies expense, contributions to charity, professional fees, depreciation of office building and office equipment, and amortization of intangible assets under administrative expenses. So we have other expenses are those which are not directly related to a distribution and administrative function. And these are the expenses and losses from peripheral or incidental transactions of the entity, including loss on sale of trading investment, a loss on sale of property, plant and equipment, loss on sale of non-current investment, on sale of intangible assets, casualty loss from earthquake, typhoon, hurricane, tsunami, flood, fire, storm surge, and other natural disaster, and expropriation loss. Now, before, we used to classify this as extraordinary items, but now they are considered as other expenses. No more extraordinary items. So, PS1 mandates that an entity shall not present any items of income expenses as extraordinary in the income statement or statement of comprehensive income or in the notes. Unusual and infrequent items of income expenses are considered component of income from continuing operations. Thus, expropriation loss and casualty loss from earthquake, typhoon, flood, fire, and other natural disaster are considered components of the income from continuing operations. In the previous slides, they were mentioned and they are considered to be other expenses. Now we have the following provision for paragraph 97, PS 1, providing that when items of income expenses are material, their nature and amount shall be disclosed separately. And also the circumstances that would give rise to the separate disclosure of items of income and expenses. Now we have the following items of income expenses requiring disclosure: write down of inventory to net realizable value and reversal of such write down. Write down of property, plant, and equipment to recoverable amount and reversal of such write down. Restructuring of the activities of an entity and reversal of any provision for the cost of restructuring. Disposal of an item of property, plant, and equipment, disposal of investment, discontinued operation, litigation, settlement, and other reversal provisions. So we have now the line items for paragraph 82 of PS1, providing that the line items in the statement of comprehensive income are revenue, gain or loss from the recognition of financial assets measured at amortized cost, finance cost, share of income or loss of associate, and joint venture accounted for using the equity method, income tax expense, a single amount comprising discontinued operations, and we have the profit or loss for the period. For the other comprehensive income, and we have comprehensive income for the period. The following items shall be disclosed on the face of the income statement and statement of comprehensive income. Profit or loss attributable to non-controlling interest and the owners of the parent. Total comprehensive income attributable to non-controlling interest and owners of the parent. An entity shall present additional line items, headings, and subtotals in the statement of comprehensive income or separate income statement when such presentation is relevant to and under standing of the financial performance of the entity. Now we have the forms of income statement. Here we have to present on the face of the income statement an analysis of expenses using a classification based either on the function of the expense or their nature within the entity, whichever provides information that's reliable and more relevant. Accordingly, the income statement may be presented in two ways, the functional and the natural classification. So we have now the functional presentation is the traditional and common form of income statement. The functional presentation is known as the cost of goods sold method. This form classifies expenses according to their nature as part of the cost of goods sold, distribution cost, administrative activities, and other activities. Entities classifying expenses by function shall disclose additional information on the nature of expenses, including depreciation, amortization, and employee benefits cost. Natural presentation is referred to as nature of expense method. Expenses are aggregated according to their nature and not allocated among the various functions within the entity. In other words, the natural expenses are no longer classified as cost of goods sold, distribution costs, administrative and other expenses, and those which are of the same nature are grouped or aggregated and presented as one item. Now we have this statement of comprehensive income in addition to the income statement. A statement of comprehensive income is prepared in order to show the total comprehensive income. The statement of comprehensive income starts with the net income or loss as shown in the income statement, plus or minus the components of other comprehensive income. The purpose is to provide a more comprehensive information on financial performance measured more broadly than the income as traditionally computed. Then we have this statement of changes in equity. Now, actually, this is already part of chapter 5. So we have the following objectives: to define equity, to identify or to determine the preparation or how do we prepare the statement of changes in equity, to identify the components of equity, and to identify the items directly affecting retained earnings. So we have now this statement of changes in equity. As we define equity as the residual interest in the assets of an entity after deducting all of the liabilities. In other words, equity is the equivalent of net assets, meaning total assets minus total liabilities. Although equity is defined as residual, it may be subclassified in the statement of financial position. In a corporate entity, the following subclassifications may be shown separately. Share capital, funds contributed by shareholders equal to the par or stated value. Share premium, funds contributed by shareholders in excess of par or stated value. Retained earnings, which may be unappropriated and appropriated. The holders of instruments classified as equity are simply known as owners. So we have now this statement of changes in equity being a formal statement that shows the movements in the elements or components of shareholders' equity and shall present a statement of changes in equity showing one comprehensive income for the period. For each components of equity, the effects of changes in accounting policies and correction of errors. For each components of equity, a reconciliation between the carrying amount at the beginning and end of the period separately disclosing changes from profit and loss, each item of other comprehensive income, and transactions with owners in their capacity as owners, showing separately contributions by and distribution to owners. Now we have this statement of retained earnings showing the changes affecting directly the retained earnings of an entity and is now part of the statement of changes in equity. The important data affecting the retained earnings that should be clearly disclosed in the statement of retained earnings are net income or loss for the period, prior period errors, dividends declared and paid to shareholders, effect of changes in accounting policies, appropriation of retained earnings. Now, the following items are directly affecting retained earnings. Net income or loss for the period. Net income is added because it increases retained earnings and net loss is deducted. Prior period errors shown as adjustment of the beginning balance of retained earnings to arrive at the corrected beginning balance. If the net income of the period is understated, the amount of the error is added to retained earnings. However, if the net income of the prior period is overstated, the amount of the error is deducted from retained earnings. Dividends to shareholders. The dividends declared or paid during the year shall be deducted from the retained earnings. Effects of changes in accounting policies shown as an adjustment of the beginning balance of retained earnings. If the net income of prior period is understated because of the change in accounting policy, the effects added to the beginning retained earnings. If the net income of prior period is overstated because of the change in accounting policy, the effect is deducted from the beginning retained earnings. So next, we have retained earnings. Appropriated is deducted from the unappropriated balance of retained earnings. Conversely, if the appropriation is subsequently unsold, it is reverted or added back to the unappropriated balance. So we have the following examples of the appropriated retained earnings, no? And we have the reasons why we have appropriated retained earnings. Legal requirement, as in the case of treasury shares. So you'll have now retained earnings appropriated for treasury shares. B, contractual requirements, as in the case of bond redemption. So in this case, you will have a sinking fund cash and you will have now your retained earnings appropriated for bond redemption. And the entity policies in the case of appropriation for contingencies. Okay, that's chapter 5. Now we move on to chapter 6. Chapter 6, non-current asset held for sale. So chapter 6 is non-current asset held for sale. Now, with the following items to be included in non-current asset held for sale. And of course, we have to consider the objectives. Definition of asset held for sale, conditions for classification, measurement, and presentation, right down to fair value and change in classification. Okay, so we have now your non-current asset held for sale. And here we have included already discontinued operations, which is part of chapter 7. Now with the following objectives, to understand the recognition of non-current asset held for sale, the conditions for the classification of non-current assets held for sale, the measurement and presentation of current assets held for sale, and to identify the recognition of non-current asset that ceases to be classified as held for sale. And since we have included in this chapter, no, combining current asset held for sale and non-current asset, I mean, held for sale and discontinued operation. So we add the following objectives to understand the concept of this continued operation, to identify the recognition of this continued operation and the presentation of this continued operation in the income statement, and also to identify the preparation of this continued operation in the statement of financial position. Actually, I am adding these objectives in connection with the addition of discontinued operations to non-current asset held for sale. So non-current asset is an asset that does not meet the definition of a current asset. And it may be an individual asset like land and building or disposal group. A disposal group is a group of assets to be disposed of by sale or otherwise, together as a group in a single transaction, and liabilities directly associated with those assets that will be transferred in the transaction. Non-current asset held for sale, according to PFRS 5, paragraph 6, it provides that the non-current asset or disposal group is classified as held for sale if the carrying amount will be recovered principally through a sale transaction rather than through continuing use. It means that the entity does not intend to use the asset as part of the ongoing business, but instead intends to sell it and recover the carrying amount principally through sale. Now, the conditions for classification as held for sale, a non-current asset or disposal group shall be classified as held for sale if the following conditions are present. The asset is available for immediate sale in the present condition, subject only to terms that are usual and customary for sale of such assets or disposal group. In other words, the current condition of the asset should be adequate to be effectively sold as seen, and the sale must be highly probable. Now, the definition of highly probable. For the sale to be highly probable, the following must be met. Management must be committed to a plan to sell the asset, an active program to locate a buyer, and complete the plan must have been initiated. The sale is expected to be completed, a completed sale within 1 year from the date of classification as held for sale. An extension of the 1-year period does not preclude the asset or disposal group from being classified as held for sale if the delay is caused by events or circumstances beyond the entity's control. The asset or disposal group must be actively marketed for sale at a sales price that is reasonable in relation to the fair value, and the actions required to complete the plan indicate that it is unlikely that the plan will significantly change or withdrawn. Measurement of asset held for sale. Here, an entity shall measure a non-current asset or disposal group classified as held for sale at the lower carrying amount or fair value less cost of disposal. PFRS 5, paragraph 25 further provides that a non-current asset classified as held for sale shall not be depreciated. So naturally, shall not be depreciated because you are already planning to sell it. Write down to fair value less cost of disposal. If the fair value less cost of a disposal is lower than the carrying amount of asset or disposal group, the write down to fair value less cost of disposal is treated as an impairment loss. If the non-current asset is a disposal group, the impairment loss is apportioned across the assets based on carrying amount after writing off any goodwill first. Now we have the revalued asset classified as held for sale. When an entity adopts the revalued model for the measurement of assets, any asset classified as held for sale should be revalued to fair value immediately prior to the classification as held for sale. The additional revaluation surplus is equal to the fair value at the classification date less the carrying amount at that date. Any cost of disposal at classification date should be recognized as impairment loss for the period and deducted from the asset held for sale. However, at subsequent year end, the revalued asset classified as held for sale shall be measured at the lower of carrying amount and fair value less cost of disposal. Abandoned non-current asset, an entity shall not classify as held for sale a non-current asset or disposal group that is to be abandoned because the carrying amount will be recovered principally through continuing use, or the non-current asset is to be used until the end of the economic life. Temporarily abandoned provides that an entity shall not account for a non-current asset that has been temporarily taken out of use as if had been abandoned. For example, an entity ceases to use a manufacturing plant because demand for its product has declined. However, the plant is maintained in workable condition and it's expected that it will be brought back into use if demand picks up. In this case, the plant is not regarded as abandoned. Change in classification of these accounts. So we have now the change in classification. I am still discussing non-current asset. Okay. So we have now the change in classification of this non-current asset. A change in the method of disposal. We have the presentation classified as held for sale. Assets classified as non-current in accordance with PS1 shall be reclassified as current assets until they meet the criteria to be classified as held for sale. Simply stated, a non-current asset that's already classified as held for sale shall be presented separately as current asset. And if the non-current asset is a disposal group classified as held for sale, the asset and liabilities of the group shall be presented separately and cannot be offset as a single amount. In other words, the assets of the disposal group shall be described as non-current asset classified as held for sale, presented separately as single amount under current assets. So take note of this very, very important change. The liabilities of the disposal group shall be classified as liabilities directly associated with non-current assets classified as held for sale, presented separately as single amount under current liabilities. Now we have the change in the method of disposal to clarify the accounting treatment when an entity reclassifies an asset or disposal group from held for sale to held for distribution to owners without any time lag. The change in classification is considered a continuation of the original plan of disposal, and the entity shall continue to apply the held for sale or held for distribution accounting. In other words, the asset shall be measured at the lower between carrying amount and fair value less cost to distribute. At the time of reclassification, the entity shall recognize any impairment loss or subsequent increase in fair value less cost of disposal. The change in classification does not in itself extend the period in which a sale has to be completed. Next, we have discontinued operations, again with the following objectives: to understand the concept of discontinued operations, to identify the recognition of discontinued operations and the presentation of discontinued operations, and the presentation of discontinued operations in the statement of first income statement and second in the statement of financial condition. Now we are trying now to determine, no, and find out how this discontinued operation should be presented. A discontinued operation is defined as a component of an entity that either has been disposed of or is classified as held for sale and represents a separate major line of business or geographical area of operations. Is a part of a single coordinated plan to dispose of a separate major line of business or geographical area of operations, is a subsidiary required exclusively with a view to resale. Component classification as held for sale. the discontinued operations accounted for as a disposal group classified as held for sale, and the component of an entity must be available for immediate sale in the present condition, and the sale must be highly probable. Now, the timing of reporting, a component of an entity is classified as discontinued operation at the date when the entity is actually disposed of the operation, when the operation meets the criteria to be classified as held for sale. And paragraph 12 of PFRS 5 prohibits the retroactive classification as a discontinued operation when the discontinued criteria are met after the end of the reporting period. As stated otherwise, if the discontinued criteria are met after the end of the reporting period, an entity shall not classify the discontinued operation as held for sale in the current financial statements. Now we have the component of an entity. It may be a subsidiary, a major line of business, or geographical segment whose operations and cash flows can be clearly distinguished operationally and for financial reporting purposes from the rest of the entity. The component can be clearly distinguished operationally and for financial reporting purposes if the assets and liabilities and the revenue and expenses are directly attributable to the component. Assets, liabilities, income, and expenses are directly attributable to the component if they would be eliminated when the component is disposed of. Accordingly, a discontinued operation occurs when the operations and cash flows of that component have been or will be eliminated from the ongoing operations of an entity, and the entity will have no significant continuing involvement in that component after disposal. Now we have the examples of these continued operations: selling by a diversified entity of a major division that represents the entity's only activities in the electronics industry, selling by a meat packaging entity of controlling interest in a furniture entity. All other operations are in the meat packaging business. Selling by an entity of all its radio stations. The entity's remaining activities are television and publishing house. The conglomerate is engaged in commodity business, real estate, manufacturing, and construction. Selling of any of the four is discontinued operations. But on the other hand, the following are not discontinued operations: phasing out of a product line within a product group, shifting of production or marketing activities for a particular line of business from one location to another, closing of a facility, factory, or branch to achieve productivity improvement or other cost of saving. Income statement presentation: an entity shall disclose a single amount comprising the total of post profit or loss of the discontinued operation and the post-tax gain or loss recognized on the measurement of fair value less cost of disposal or on the disposal of the assets or disposal group constituting the discontinued operation. Simply stated, the income or loss from discontinued operation net of tax shall be presented as a single amount in the income statement below the income from continuing operations. So we have now the presentation in the statement of financial position separately on the face of the statement. of financial position the following. A. Assets of the components held for sale separately. B. Assets held for sale are measured at the lower of fair value, less cost of disposal and their carrying amounts. Liabilities of the components separately from all other liabilities, and non-depreciation, non-current assets of the component held for sale shall not be depreciated. And PFRS 5 paragraph 3 provides that the assets of the components shall be presented as single amount under current assets, and the liabilities of the component shall be presented as a single amount under current liabilities. And the assets and liabilities of the component cannot be offset against the other. And if a disposal group is classified as held for sale in the current year, an entity shall not reclassify or represent the assets and liabilities of the disposal group for the prior period to reflect the held for sale classification in the statement of financial position as of the end of the current reporting period. In other words, the presentation of the assets and liabilities of the disposal group in the prior period is not changed. So we have now the cash flow presentation. The cash flows attributable to operating, investing, and financing activities of this continued operation shall be separately presented in the statement of cash flows or disclosed. Okay, so that ends up to chapter 7. I will be continuing with chapters 8 and 9 for Monday, and possibly begin with the problems. So for your assignment for Monday, you begin solving or answering the questions in first we begin with chapter 1. So you answer all the multiple choice questions. Then in chapter 2, you have to study again and answer 2-1 and 2-2. Okay? So I think that's all for Monday, because before that solving and answering of the questions, we are going to continue with the theory of chapters 8 and 9. Okay? So, convert ka na. Tikidoy isa ka oras. Kung nga, ano